Today, folks, I never thought I'd be saying this, but I sold SCHD in favor of the S&P 500's VOO in my registered retirement savings plan. And I want to talk about the thought process I went through that got me to this decision, because I've recently been going through the top holdings in SCHD that make up 50% of the portfolio, because there's been a lot of earnings and I pay attention to the companies that I'm invested in. And I asked myself, would I buy these on an individual basis? And 8 out of 10 times roughly, I said no. And I asked myself, on my path to financial independence, to retire early, that journey, do I really need these dividends today? As I've told you, my goal was to get about a 3% yield on this portfolio, but because I don't need that cash flow, I have an emergency fund, I'm good for 12 months if something happens, I don't need to tap into this portfolio. Why do I focus so much on the dividends when the companies that get me excited, where I see the future going, isn't in SCHD? It just didn't make sense to hold it. Now, don't get me wrong, I think SCHD is still a great ETF for those looking for income, but at the same time, it just doesn't fit my personal planning. So I want to break down SCHD in this video, the top holdings, why I made this decision, because even comparable to the other ETFs that I like, there's starting to be quite a divergence. On the back of this volatile market, this tariff war with recession fears, SCHD is actually starting to underperform the S&P 500's VOO. It is underperforming VDY on the Canadian side of the market, and with global markets starting to expand, I've even seen better performance in XEQT. So I really had to do some deep internal thinking here, and I want to break that thinking down for you. So if you are on a path to financial independence, if you damn well one day want to retire early, go ahead, hit that subscribe button, join me on that journey here, folks, because yeah, I'm not going to be yield chasing anymore like I used to, and I'm going to purely be total return and performance chasing, at least for the next 3 to 5 years, while I try and fast track my financial independent journey. And even still, at the scale of my portfolio, I'm able to bring in $500 a month in my combined portfolio, which I'm still very comfortable with, giving me some cash to reinvest. So taking a look at SCHD, the current top holdings after the reconstitution, I really have been thoroughly breaking these companies down for myself, and I'm just going to broad view them for you based off revenue, earnings per share, and if they're doing share buybacks, because I always see a bit of manipulation going on with some of these companies. And again, a lot of these I would not be buying today. So if we take a look first and foremost at Coca-Cola as an example here, this is a great company. It is, however, trading for pretty extreme values. The yield's not that exciting, and the company's growth is starting to stagnate to the low to mid single digits, whereas through 2021 it went through this really nice growth phase. And if we take a look at the earnings per share, there hasn't really been any earnings per share growth, even on the back of some of the growth they had. And if we take a look at shares outstanding, they are doing a little bit of share buybacks, but nothing extreme to the level that we see with some of these mega cap tech companies. So Coca-Cola, I think it's a great dividend stock, but would I want to hold it? Not for where I'm at in my current journey. If we take a look at ConocoPhillips, another stock that's been stagnating here for quite some time since 2022, the revenue growth has been absolutely, these are shares outstanding. We got to go to revenue growth. I have this left to open, but they've been doing a lot of share buybacks. I mean, 3 to 5% share buybacks is quite aggressive, but this company has virtually no revenue growth. So what these companies will do to bolster their earnings is they buy their shares back, so the same revenue and net income against the fewer shares outstanding actually bolsters their earnings per share. But even with the share buybacks, they haven't been able to bolster their bottom line, which is something that you'd want to look into and ask yourself how, because their net income is going down, though revenue hasn't really changed, and the shares outstanding have been getting bought back aggressively. So these are kind of like red flags to me to have absolutely no growth here. It doesn't get me that excited. Now, Verizon, on the other hand, is a stock I would buy. I do like Verizon because I still think it's an interest rate recovery play. I think the company has strong fundamentals, consistent revenue. People are, not going to give up on their phone or internet bills. And the fact is interest rates get cut in the US, and I know it's been a bit delayed, longer than I would expect. These are infrastructure companies. They have a lot of debt on the balance sheet, and they've had to pay a lot of interest expense, right? So the stocks did get hit pretty heavy, but I think they're trading cheaply at where they will be once the earnings are able to recover, right? So it trades at a reasonable value, great 6% yield, very consistent revenue. If we take a look at net income has started to recover a bit, so I'm not sure if they had some extra expenditures like we've seen on the telecom giants in Canada, TELUS, Bell. They've all been doing restructuring, which is very expensive, but they're short-term expenses, right? So there might be something similar going on here. If we take a look at the shares outstanding, the company isn't really buying shares back, which doesn't get me all that excited, but I still believe this is a great dividend stock that I wouldn't mind owning just for the short-term potential recovery bump. If we take a look at Altria Group, this is probably my least favorite stock and has been for years. In the sin stock sector, for those that like the cigarettes and all that stuff, I really like the international trade where we've seen growth in this segment when it comes comes to British American Tobacco. Philip Morris is an example. And I'm not sure, Altria has rallied quite a bit, but I think this company is highly manipulative. I do not trust management. They've done a horrible job with recent investments, as we've seen in the MJ markets, the vapor markets. They failed at every turn they've made, costing shareholders billions of dollars, while the CEOs still bump themselves and give themselves raises. And you see that in the absolute horrible revenue. This is just consistent revenue decline that's been going on. I mean, we know that cigarette smokers in the Western world have been declining at almost double-digit paces, and they've been fighting to maintain and find new sources of growth that they just haven't been able to get footholds in. So what we've been seeing is a company that has been manipulating their books to try to squeeze margins by increasing prices. So we've seen quite an increase in earnings per share, or net income, which probably driving some earnings per share growth. But if we take a look at shares outstanding, they have been buying back aggressively as well their outstanding shares to also bolster that EPS. So I feel like they're just manipulating their books, doing some fun accounting work to basically justify some of the growth that's been driving the stock rally. But I'm not a fan of this company overall, and it's not one that I would buy. Lockheed Martin, I think, is a good defensive play. I do like this stock, but you have to recognize on the back of all these geopolitical events, you think this would be doing much better, but I feel like the world at war is evolving. I mean, we've been seeing 3D printed drones, so much stuff going on here that I think could be disruptive to this company as, technology evolves. And this company has not been growing revenue at any, incredible pace from an earnings per share standpoint. Revenue's been bumping up a little bit, but nothing extreme. I mean, we're talking about 1% to, no revenue growth at all. Shares outstanding, however, again, another company that's been repurchasing shares quite aggressively, which has been bolstering that EPS. So again, from a fundamental standpoint, would I be excited to buy this? No. Is it a great defensive play? Sure. Do I see a bright future for it? Unless they're evolving, and I haven't looked into it too much into, where this weaponry is going. It's not a sector I understand that well either. Home Depot is a company I still love today. I still think once the markets start to recover, interest rates get cut, and people go back to doing a lot of home flipping and scaling, the housing market has been kind of dampered in this current environment, but that doesn't mean I don't like Home Depot, and it's upper weighted in the S&P 500, so I do get reasonable exposure to it anyways. It's not a cheap company by any metric, but it is a company that is starting to show signs of revenue growth again, which is what I like to see. If we take a look at net income has been stagnating. Earnings per share also stagnating against that net income. If we take a look at shares outstanding, the company has been buying back, not as much as recently, but still. This could also be looked at as somewhat of a recovery play, and one that personally I still think is a great company. But if you compare it to something like Google, or Microsoft, I wouldn't say this is like the greatest company on the planet, but not one that I want that large of exposure to. If we look at something like Chevron, I'm a little concerned for the energy sector, and this is a concern I have for some of my Canadian stocks like VDY. But you have to recognize that oil has dropped significantly, and somehow Chevron, Exxon, a lot of these oil stocks have maintained their share price over the last 3 to 4 years. And I think we're kind of coming due because revenue is starting to stagnate and drop. And I think the next couple earnings are not going to be that incredible. If we take a look at the earnings on this one, they have started to drop off quite materially. And it is a company that is buying shares back quite aggressively. I know this is a Warren Buffett stock, I believe. I know a lot of people like this sector because there's a lot of stability. It's a consistent business that's not going anywhere, but it is, cyclical because oil prices tend to fluctuate, as we've seen over the last 5 to 10 years, quite dramatically. So I'm not a fan of oil. I never have been, and I get enough exposure to the Canadian markets, but I like the Canadian markets a bit more because you get pipelines, and I'm sure some of these companies do have pipeline exposure, but I like the pure play of Enbridge, some of those companies that are upper weighted in VDY as well. Amgen, if we take a look at Amgen, get into some of the biopharma stocks, these also trade for pretty high multiples today, but they are seeing quite a good amount of revenue growth. Are we talking like anything outside of tech revenue growth? No, we're talking about, low to high double digits in some cases. We take a look at the earnings per share growth here. They're not really actualizing a lot of that revenue to the bottom line, which kind of comes as a shock to me, and they're not buying shares back as of recently. I do like this space overall, but we'll come back to it when we look at some of the other stocks that are healthcare related in SCHD. You've also got Cisco in here, another communications company, trading at also fairly high values for very little growth that we've seen. Revenue not really going anywhere. Earnings per share, we'll just kind of skim through these real quick. It's starting to go down. Shares outstanding, still being bought back, right? So now we're going to look at Pepsi, a stock that I used to love a lot, but recently has been struggling dramatically. I mean, I'm shocked to see Pepsi not really getting a foothold, being down 32%. Again, past performance does not equal future return. This is a company that, I think is reaching somewhat maturity. It's really hard to innovate in the food space and find massive growth sectors that can, outpace what you already have as a foothold. And revenue has been plateauing as of recently. Earnings per share, if we take a quick look here, has been plateauing. Shares outstanding obviously being bought back to kind of make up the difference, but not in a huge way. Again, these are very mature companies that I think are great for people that want sustainable income. The yield is 4%, which is higher than it has been in a very long time. If we actually go take a look, let me see if I can find the other metric. If we take a look at other metrics just to see, this is the highest yield Pepsi has ever paid. And typically I use this as an indicator that says, hey, this might be a good stock to be paying attention to because it's a traditional company. And you can kind of use this as, hey, this might, again, be a good time to be getting in here. But you got to ask yourself, if there's no growth moving forward, I mean, are you willing to pay like a 19 times multiple? The company is still trading at pretty high valuations, even based off those last earnings. So this could be a bit of a red flag that the company is moving into a troubling time, or an indicator that, hey, this could be a good buying opportunity, which I typically only see for like financial institutions like the big banks. Typically when their yields start to excel into this, they're companies that I know can recover, because again, everyone needs banks. They don't go through too much cyclicality, but the food industry is a hard one, to wrap your head around. But again, I still think it's a great income stock overall. It's just not one that I'm excited to buy here, right? So if we look at Merck & Company, another healthcare company, this one's also been stagnating quite a bit. I mean, it is down 30-40%. Some of these stocks are getting hit harder than a lot of the tech companies right now, and it trades for, we'll see what's a reasonable value at 11 PE. It's still got some revenue growth coming behind it in the mid-single digits, which isn't terrible. If we take a look at those earnings per share again, they started to justify some earnings per share here. We've seen a bit of a bump up. If we take a look at the shares outstanding, they've also not been buying shares back. So overall, again, nothing crazy. Nothing stands out to me here where I'm like blown away, right? Or I'm like, oh my God, I need to own these companies. They're trading at great values with great growth. They're just mature companies that just offer reasonable yields and are able to grow those yields on the back of what they're sustaining. So AbbVie's a great company, trades at a really high multiple today. If we take a look at the earnings, maybe not that great, right? If you look at the stock price, you get kind of a little bit deceptive because you got to ask yourself, why are so many people buying into it? What's the future pipeline? Why are they getting so excited? Because we're still talking about low single digit revenue growth, earnings per share growth, starting to come up, actually down, declining, shares outstanding, no share buybacks. These are the top holdings in SCHD, guys. I'm not over the moon about any of this. And it kind of makes me sad, to be honest, because there was a time where I was quite a bit more excited about this and getting the diversification, but with a lot of exposure to energy, consumer staples where we're just not seeing growth, tariffs, inflation, interest rates, all this stuff seemingly affecting it harder than you would think some of these huge tech companies. Healthcare is where I get a little bit more excited for defensive play. But overall, like I said, when I look at this ETF these days, I get it. It is a great income producing ETF for those looking for cash flow that don't want to have to sell off their stocks. For my parents, it's a good section of their portfolio, but I wouldn't make it like a total portfolio, right? I don't think it's something you need that large of exposure to, and you should diversify your income through other ETFs that have had great growth. Because again, past performance doesn't equal future return, but when I'm looking at earnings today and I'm looking at some of the drop-offs I've seen in VOO, I mean, look at these top holdings. Apple, I'm not that excited about, obviously. Doesn't mean the company can't find some growth in the future, and they probably will when interest rates come down. But yeah, Microsoft, I think, is great. Might be a bit expensive, but the values have come down. NVIDIA is looking cheap today. Amazon is looking cheap. Meta's looking cheap. Berkshire has been very reasonable, one of the best defensive plays. Google's looking cheap. Tesla, very expensive, but at 1.52%, am I complaining? No. We go a little bit farther. JP Morgan, I love, and I don't know why it's not in SCHD. Eli Lilly, Visa's great. Exxon, like I said, I'm a bit questionable of. United Health, I'm a bit questioned of. MasterCard's great. Costco's a bit expensive, but it is still a foundational company that's not going anywhere. Procter & Gamble's been getting hit quite hard as of recently too. J&J, I think, is reasonably cheap. It's starting to turn around a little bit. Netflix has been on an absolute tear. But yeah, when I go through the S&P, I'm like, man, I get so much more excited about the holdings in here, and I see way more growth. It's a market cap weighted ETF, meaning these top holdings will adjust and auto weight based off their market cap performance. So if if Tesla finally starts to get clobbered, it'll auto deweight its way out. Whereas in SCHD, it is a managed ETF. People have to go through and, basically update it. And I do not like the mechanisms they're using to find these dividend stocks, because I think there are better dividend stocks out there like JP Morgan, some of these other companies that I just personally like more. So overall, like I said, this hasn't been an easy decision for me. I feel like I should have made it a bit sooner because I've been missing on some of the growth, and now I'm selling it when it's down. Now, did I take a gain on it? Like, I was only up 2 or 3%. I've been flat on it, which is crazy because I've been holding it for what feels like so long, to watch some of my other ETFs perform quite better. And again, now that VOO is more down in line with some of these stocks, I'm like, hey, you know what? I think it's a good time to buy the S&P 500. Between the wife and I, the S&P only makes up just over 50% of our combined portfolio still. We do have a lot of diversification in other stocks, and those other stocks are still where I think the undervalued plays are with Google, Take-Two, and I feel like this could really accelerate that growth and continue to do what the main goal is fast track our financial independence. This is why I don't buy the Qs. When I look at the QQQ or some of those growth ETFs, they do overlap stocks that I'm not the biggest fan of either, and some of them aren't market cap weighted either. So, for the time being, I figure we'll hold our growth stocks, the individual plays, as our version of a growth ETF, and then we'll start looking at still diversifying into the Canadian market with VDY, and still continue to look at XEQT. And as these stocks perform and we sell them off, we will start reallocating them into some of these other ETFs and maybe continue to bolster that global diversification. But yeah, this is a weird decision for me. It's fascinating that I've come down to this point as my thinking around the markets evolve. But I'd love to know what you think about this in that comment section below.